Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today we're diving into a topic that's more relevant than ever: how inflation and monetary policy shape our financial lives, often in ways most people don't fully understand. We'll explore the mechanisms behind inflation, why prices seem to rise relentlessly, and what investors can do to protect and grow their wealth in a distorted market. Joining me is Ivan Pavlovic, author of the book Making Money on the Money Printer. Ivan has lived in various European countries and has closely observed how economic systems affect everyday people, even in some of the world's wealthiest nations. His book unpacks the fundamentals of economics and monetary system, offering a critical look at how government policies and inflationary forces shape our economy and investment landscape. Ivan, welcome to the show.
Hi, Mark. Thank you for inviting me.
All right, so to start off, what inspired you or led you to writing the book Making Money on the Money Printer?
So, I'm still in a relatively, let's say, young age in terms of career. I'm at the moment I'm 34, and I moved from Croatia when I was 25 to live in Luxembourg, in one of the wealthiest European countries, and so having lived there for a while, for 6 years, I realized that not just me, but like a lot of people, even people from Luxembourg, young people from Luxembourg, were struggling, and obviously the situation was the same in Croatia. Lots of young people still, at my age, are not able to afford their own apartment, even a small one, on their own, right, from their own income. And so I started digging into economics. I wanted to learn more. Obviously, I work in financial sector. I got a job in finance from the beginning, although I studied law. Since in Luxembourg it's a very mainstream career path, and so I was fortunate to learn about finance through work and through some personal education, but then also separately I started learning about economics and investing on my own, because as you know, schools do a very poor job in that relation, and I just realized at a certain point that I need to educate myself and to know more. And so at a certain point, one thing led to another. I started with internet. I think internet is a huge blessing for all of us today. I was always thinking how, my parents 30, 40 years ago, they didn't have these possibilities that we have today. And so for them it was, even if they wanted to educate themselves, like they had much less resources to do it from. So this is great that we can communicate like this, from all over the world. And so I started through internet, and then I listened to this alternative space, and then I switched more and more to books and really reading about economics, especially Austrian economics, which is called Austrian because the, let's say, first movers in that space were Austrians. Okay, so I was kind of approaching the whole thing really as a layman from the side, just trying to learn practical advice and understanding of what's going on and why, and how I can obviously take some action there, because it was not, for me it was really like, how can I break through, right? And I think that's really the case for many people today. They do their best to succeed, and they do what they have been told by growing up. Get a job, study for a long time, you'll be rewarded, and then save, and then you'll be maybe able to afford a home and better future. And so this is not working. Clearly, it's not working for many people, for most people, I would say. And then what's worse, I'll finish here. What's worse is that then most people turn to blame capitalism for this, because they see that there is a small group of people that is getting very rich, while others are stagnating, or even kind of their living standard is falling down. And so after I educated myself, I decided to I decided to write the book to try to help my friends to read it, and my parents, and just in general to try to spread these ideas.
Inflation is obviously a timely topic. Someone recently, they were talking about how much the price of eggs has increased, and they said, "Well, what is it? The chickens are no longer making eggs, or so maybe let's start at a high level. Can you just explain what inflation is and what causes it?"
That's a great question, Mark, that we start from here, because that's extremely important to understand. And so I think what's, the mainstream media, when they speak about inflation, you hear all these different words, inflation, disinflation, shrinkflation, and they throw out all these different reasons for inflation. And then as you hear inflation, you basically, what you're hearing is price increases, because when they refer to inflation, this is what they refer to. But that was not the original definition of inflation, and obviously this definition always kind of varied a little bit, but it was always mostly focused on increasing the supply of money. And what is money? It is, there are again different definitions to what money is, but I think the key for your listeners to take away from this podcast is that money is just something that is mostly accepted to transact in, but normally it should be also something that preserves your purchasing power, okay? And so inflation really is, it's the increase in money supply, because the prices, they can go up and down, and what prices really are, they are the signal of supply and demand. But if you are expanding the supply of money, or in other words, if you're inflating it, then what you are basically causing is that there is more demand, because in every transaction we are using money to buy a real good or service, right? And so if you're increasing demand on one side, which is money, then it's chasing the limited amount of goods on the other side. And so this is then what causes ultimately the price increase. And what makes everything even more confusing is that many times they will say, well, if you increase the supply of money, that doesn't necessarily lead to price increases. Look, you have these periods where the supply of money was increased a lot, but prices kept falling. And so this is also what confuses people. And we need to understand a few things here. One thing is that the world today is obviously very connected, and especially for Americans, you are in a very particular position because your currency is the world's reserve currency. And so other countries use it a lot in their transactions, in their debts. And so even if you inflate the supply of US dollars, those dollars are not necessarily staying in the US economy. They can go out because they are needed outside of the US. And so you will not necessarily see the price increase, at least not immediately, even if the amount of money gets inflated. So that's one thing. We have a global global money system. And second thing is, of course, that the technological improvements in economy, the work of people, the entrepreneurs, the technology that advances the science, that moves forward, makes the production processes more efficient. And so what that means is that instead of spending 4 hours to do something, now you spend 3 hours or 2 hours to do something. And so that brings the prices down, because now the price of your labor or the capital resources that you're not using is not as high anymore, right? And so you're able to then provide your product with a lower price than before, because now you're spending less resources in order to produce it. And if you don't want to do it, then your competition will do it so that they get larger share in the market, right? So you will be forced to lower your prices ultimately. The problem is that there is a difference when we speak again about specific sectors where sometimes prices go up, and there on the other hand we can speak about the entire economy when prices are going up across across most of the goods. And so here you provided the example of eggs, and of course the price of single product in a particular location can go up or down based on many different factors, right? So it doesn't have to be just the supply of money. It is also, of course, the very supply of the product itself. So it could be that due to various reasons, the supply of eggs is lower, and that's why, if you have the constant demand, the price of eggs goes up. Now that might be for various reasons, health policies in case of chickens, that we can see, different regulations again that governments bring, but it can also be, of course, with in relation to some world events, right? So I mean, you can have some disease that hits the chickens, or you can have I'm not saying is the case here. I'm just, as a matter of thinking of various reasons. So there are wars. So wars are destructive. They can, destroy different goods, and so you can have indeed the supply chain disruptions for some reasons, right? And as well, on the other hand, you have demand that can go up or down depending on demographics and other things. But what we can commonly see when we speak about inflation is that the prices of goods in the overall economy are rising. So suddenly, across the entire country, the prices rose in a single year maybe by 2% or by 5%. So that's the key question: is like, how is that possible? So it's not just eggs, it's not just this or that. It is really that when we aggregate all the goods that exist in the economy, the prices went up for a few percent. So why is that? Are Americans just suddenly producing much less than the previous year, or what is the reason? No, it's really this impact of the money, of the supply of money, and this is what we have to keep in mind when we speak about inflation.
On the topic of money supply, why would and I imagine it's the government who's controlling if they're inflating the money supply, or on the reverse, if they're tightening it. Why would they do that? Why would they take pursue the activity of actually inflating the money supply, putting more money out there? And then how do they do that? I know the one that people kind of think about is interest rates, where they lower interest rates to kind of get money. But is there other ways that the government gets more money out into the economy?
Okay, so that's a great question, because this is another very important topic that needs to be raised. It is commonly thought that it's the government that expands the money supply, or can shrink it, of course, as well. But really what we have to keep in mind is the banking sector. The banking sector is actually the key to the money system we live in today. Because before, in the past, money was a commodity such as gold or silver that was most trusted. So it had better properties than some other commodities. So for example, gold is very hard to pull out of the ground. It's limited in quantity. It cannot be basically destroyed. It lasts for thousands of years, right? And you cannot really inflate the supply. You can just extract more from the ground, but that is a very hard process, so the supply doesn't increase that much. And so and it's, of course, it has other properties where it's not like a barrel of oil that you need to have a lot of space to store, or it's not hard to carry around. It can look, all the gold coins can look exactly the same as other ones, right? And so before, you had money in the form of metals mostly, and then of course when the paper got invented, then these metals were stored, and then papers were printed or created to let's say, be able to be exchangeable for those metals that are stored. And then, of course, the governments and also the bankers realize that they can create more paper than they have metals on the deposit. And so they were multiplying like this money supply, or the supply of papers in that relation. And of course, before the emperors or kings, they would often through entire history, indeed, until you had this modern central banking systems and modern banks, they were controlling the state money, let's say the kingdom's money, and so they were putting their coins in circulation, and then they could debase those coins if they didn't collect enough through taxes to pay for military and other expenses. But in today's environment, it's much easier to inflate the supply precisely because of what we today use as money, which is papers or even more often digits, right, which are just in the computer or somewhere in our phones. And so here I would just like to very briefly cover that. So what we call money is dollars, euros, etc. I like to think about those as currencies, and Friedrich Hayek basically said that money. He regretted that money is a noun. He thought that it would be better explained, and he would explain it to his students as an adjective. So money is more like a property of a thing rather than a thing on its own. Money can be various things, so we usually use something that is, let's say, the best form of money. And so before we had the gold standard, but it's from 1971, when President Nixon took the world off the gold standard, when before you could exchange your US dollars for gold, for physical gold, now you just have those currencies, those dollars, euros, and all these other currencies that move and trade in relation to each other. And so here we are coming to your question. So who is controlling the supply of those currencies? And we have to understand that the currency always originates from the banking system, not from the government first. It originates from the banking system. In particular, it is created first from a central bank. And central banks can be have a different setup in different countries. Sometimes they are private entities, sometimes they are fully governmental entities. But usually they're always somehow related to governments, and usually their officials are appointed by government officials. And so then you have the question of how independent they truly are. But so the central bank usually needs to first create the so-called reserve currency balance on the books of ordinary commercial banks. And then those commercial banks, they need to lend this out to someone. That's the key to remember. So ordinary banks where where most of us come and we store our savings, they are the ones who create the money. They are the ones who create currencies. The government will normally have to borrow that money from the banks, basically, right? So the governments can tax the citizens, but of course, when we are speaking about how the money is first created, they cannot tax if nothing exists, if the currency doesn't exist yet. So first they actually need to borrow. So how do they do that? So how does the government borrow the money from a bank? The government creates a bond normally, right? It creates a bond and then it sells it basically to a bank. So banks buy those bonds. And then banks can, of course, trade those bonds further. But the point is that when then banks pay to the government for the bond, they have essentially lent the money to the government in that sense. So the government can then pay its duties to, its government officials, to the retirees, for pensions, etc. But so even when the government, let's say, creates money, we are actually talking about banking system who created money first, not the government. But the key here is in this story is that the government now has to repay that money back to the banks with interest. And where will it get the interest? It will get the interest from the citizens who now have to work and produce more than was lent out to repay those loans. Now that's one way of creating money through the government, and the other way is, of course, when you or me, we go to the bank and we ask for a loan. We ask for a loan to buy a house, to buy a car, or go for a ski trip. And so we come and we say, can you please borrow me $100,000? And the bank will assess if we are worthy of it, credit score, etc. And if they consider us more or less safe, they will lend us the money. But they are not really lending out something that already exists. They can just create those digits. They can just create that paper and push it into circulation. And that's it. And now it has to be repaid back with interest. And where is the interest coming from? Other loans need to be created. So there have to be always more and more loans created so that the previous loans can be repaid with interest. So that's really the mechanism of money creation. And I will just add here on this topic that your listeners should really keep in mind something else. And that is, again, I like to mention it, especially here on your podcast, again, because I'm assuming that most of your listeners are Americans. The United States, so its financial system is not solely in charge of US dollar. It obviously plays a dominant role through Fed and its banking system. However, there is a whole so-called Eurodollar system outside of the US that creates US dollars. And I'll put it very simply. I live in Europe, and if I would want to, I could probably get a loan from my bank in Europe in United States dollars. So instead of borrowing in euros, I could actually borrow in US dollars. And so the European banks could create loans in US dollars, and they could basically, through those loans, they could inflate the US dollar supply. And so in that sense, it's just important to recognize that it's not solely the governments or even solely the central banks who are in charge of money supply. It's really the banking system in general and all this kind of shadow financial institutions system, these different types of entities that can create money, and nobody really knows, the exact amount at any given time of how many, dollars or euros are out there actually.
What would be the purpose that someone in Europe would want a loan in US dollars versus one in Euro dollars or euros?
So because US dollar is a world reserve currency, lots of businesses like to sell their goods in US dollar. So because it's easy, it's just a convenience. And so that's why you can have a company in let's say Thailand or maybe India or China. They could be transacting in US dollars in selling their products cheaply to entire world. And so it could be simply safer, let's say, for them and easier to just get a loan in US dollar than in their own currency, because their product will be paid back in US dollars. And so if they receive back the dollars, they know always that the nominal amount that they can pay back to repay their loan, so they don't have the currency risk as well, right? And so Also sometimes interest rates, because of the dollar's relative stability, are probably much lower than borrowing in local currency, and so there are these different practical reasons why world obviously through decades has been relying on US dollar.
Well, going back to what you mentioned about how the government, they need to finance their operations. So when they interact with the banks, and they're essentially borrowing money from the banks. But a lot of what you hear also is, oh, inflation is running hot. We need to take this. The government needs to take this action to cool things down, or it needs to, and it starts playing around with interest rates. How does that affect or does it have an effect on the monetary supply that's out there?
Yes. So basically, the governments, or more again, there is a division between policies that on one side where you have the government, through issuing through issuing of the debt instruments, right? So of bonds can impact the money supply, and then the central banks who can basically be impacting the price of money through raising it or lowering interest rates, as you said. So that's why on one side you can have, for example, Fed, who is raising interest rates, and then on the other side, Treasury Secretary like Janet Yellen, who was issuing lots of short-term bonds, and through this she was increasing the money supply while the Fed was tightening the money supply, and so they can have different policies at the same time. I'm sorry, what was the question?
Is like, I guess, well, one, why would the Fed
Yes.
in addition, I understand that they have to finance their operations, whether it's the military or some of their programs they have. But why are they concerned if inflation goes up or if inflation is down? Why do they have a target inflation that they're trying to target, and then how does their actions correlate to that target that they have?
So what they want is a constant growth of debt, and of course they want the debts to be repaid, and they don't want the system to collapse, and so they need to be constantly increasing the money supply. But also because they are increasing the money supply, so again we have to keep in mind the when we speak about why they do it, right? Why they increase it. Sometimes it's to help other entities that are in trouble. And so I'm speaking about the United States. You can have issues in Europe where European banks or other entities have issues with US dollar denominated loans. And so in that sense, you can have sometimes the Fed taking action and providing US dollars to those troubled entities outside of United States. But then speaking about cooling the economy, what you asked, why they take measures, let's say, to, as you said, cool inflation, bring it down. Obviously, people are not happy when they see prices rising very fast, and so the so-called consumer price index, which measures how much the price of goods has gone up in percentage terms, it doesn't really measure inflation as I'm defining it, as an increase of money supply. It's measuring the price increases. So again, the CPI can easily, it masks how much we could have gained in terms of prices going down had there not been any inflation. So if the government or if the central banks were not creating additional currencies, then the prices would naturally be going constantly down, because due to technological progress, things would cost less and less with time. So your salary would actually be worth more and more over time, right? So they don't like to see that the prices are going up very quickly, because that means that then the citizens will start asking why that is happening, and they will be blaming, of course, the current politicians in place for their diminishing standard of living. And so they want to keep prices going up constantly, but at the same time they must not overdo it, so they must be careful how quickly they do it. So that's let's say a bit of dynamics there.
Now, if we go into a little more specifics, how does all this inflation, the monetary supply, impact market sectors, asset classes differently? And then kind of a follow-up is then how does it also impact the individual person as well?
So obviously there is when we speak about assets and our lives in general, of course, I just want to mention before going into this that there are lots of things, again, that an investor or just an ordinary person needs to have in mind when investing or just living their lives. Obviously, inflation, the manipulation of money supply is not the only thing that impacts it. There are regulations, there are taxes, there are natural disasters and other events that can have impact, right? And wars in different areas of the world. But usually when we speak about the entire country's economy in standard times, when there is no war, when there is no famine or something like these sudden diseases, we sometimes see that there is a huge crisis. For example, in 2008, you didn't have some war that came and suddenly half of country was going down because of the war or because of some big disease or something like that. Suddenly the whole economy was just going down. The financial system was on the brink of collapse. So how does that happen? And Austrian School of Economics here really offers the only logical explanation from all, as opposed to basically the Keynesian School of Economics, which is predominant today in the mainstream educations. And what the Austrians say is that because the money supply is manipulated, that creates distortions of interest rates, and interest rates are price of money. So because in normal times, when money is something that is tangible, such as gold, when you have increased supply of gold in economy, and when people save more gold, right, they will then put it on the bank accounts. And so because there is more and more gold accumulated in the banks then need less and less gold. So that means that the banks are, in other words, ready to pay less for that gold to be on their deposits. So they're paying less, meaning the interest rate will go down naturally if the gold is saved. There is more savings, meaning the interest rates are naturally going down. That, of course, then means that when they are lending further, they are able to offer lower rates than before. So they will pay less to the saver to keep the gold on deposit because now they have more gold in savings. But they will also be able to lend out the money because with a lower interest, because there is, of course, their price to borrow that gold, to have it on deposit, is lower. Okay, so this is the basic dynamics. And so when we are talking about these fiat currencies, the dollar, the euro, that are not backed by something tangible, that are not backed by gold, what happens is that you suddenly, if they print money, so they increase the supply of those currencies, what happens is that then those currencies are ending up on bank accounts because people, they always put them somewhere in a bank, whether they buy something or they're saving. That money is getting ultimately stored in the bank accounts. And so what then happens is that there is a suddenly appearance, once the money is created, it's deposited on accounts, and there is appearance now that there is more savings in the economy. But nothing new was really created. There were no new products created. There is no more gold mined from the ground. There is no more value for people created in the economy. There is just more digits. That's all. There is just more worthless paper. And so what that creates is the illusion that there is more savings out there. So for whom is this important? So it's important for those who are building businesses, because if there is more savings, again, we are talking about interest rates now going down, but this is artificial. This is an illusion, right? Because nothing more was really saved. There's just more currency out there. And so the interest rates artificially go down. And so the entrepreneurs, they see this and they then borrow the money with these lower interest rates because they think that people are saving more for future consumption. And so now those entrepreneurs go out and they invest in goods that are needed for capital production, such as new machinery, or they build new things that basically are needed in the production process. But then, of course, all these entrepreneurs who are now borrowing, they are competing for the same amount of those capital goods. And so somewhere down the line, what will happen is that price of those goods will suddenly go up. So many of these entrepreneurs will actually not be able to afford those goods because there is just not enough savings in the economy. And so this is when they will realize that their calculations were wrong, and so they will stop this process. And so what will happen is that then you have this thing that we call recession across the country, which is actually curing of the mistake that came to being previously in the moment when the money was lent to them, right? So because there was artificial boom, they were all borrowing and creating jobs and expanding businesses based on wrong assumptions. And so this is from the entrepreneurial perspective, and of course for many subjects in the economy, this is a huge thing, and I think it's initially not as easy to understand, but it's really the very important thing to understand when talking about these booms and busts and general recessions that happen cyclically without some trigger from outside. So that's from that perspective, I would say. And when you ask me also about the assets, the value of assets, of course, the assets trade with, in relation to one another. So people, here we have to keep in mind that there is no realistic value of something. People have their subjective value in mind when they are buying something, right? So for me, what does that mean? For me, I might be ready to exchange my $10,000 for a certain car, but maybe only $100 for a certain painting, right? But someone else might not be valuing this car that much, or even at all, but they might be willing to pay for the painting $10,000, while I'm just willing to pay $100. So the value is it's basically subjective. It's what do you value more? Do you value more those $10,000, or do you value more that painting, right? And so this is where the buyer and the seller will meet once they both think that what they are getting is worth for them more than what they are giving in return. This is the foundation of every transaction in the economy. And so the same is kind of thing with assets. Usually what inflation does is, as there is more and more inflation, the interest rates are lower and lower, meaning the saving is discouraged effectively, right? It's not worth having your money on the bank if you're just getting 0.5% for that money per year, right? So you will go and seek out something that you think that will bring you more money, that is safer. So that's the key. You are thinking that this is better, right? Better deployment of your money. And so this is why then you can have bubbles in asset prices, because people will start initially investing in something that has, that is reasonably valued, let's say, but then those prices will ultimately go up and up and up and up, and then eventually people will, lots of people will just have some recency bias, and they will be like, okay, well, last year this house was that much, so I'm more or less willing to pay that price. But there is that's just because the demand is so high, and the demand is high because all those loans are being created because of the increase in money supply. But once there are no more loans issued as much, for example, because the banks are not ready to borrow as much anymore. Not ready to lend as much anymore, because they cannot find any more sufficient number of worthy borrowers. Then the lending decreases, and so if lending decreases, that means that the supply of money will start decreasing as well. And so you kind of have this dynamics, right, of inflation and deflation, because if banks are not lending money, if there are not enough borrowers, then the money supply will start to go down. And if that happens, people will need more of their money to cover for their other debt obligations or for their cost of living, and so they will start selling assets. And so usually what happens is that in certain markets, the smart money, so-called smart money, is the very educated people. They will recognize when something is in a bubble or hyper bubble. They will usually recognize first, and they will start allocating capital first into some other things. But many people will not recognize this immediately, and so you kind of have you also have this psychological factor in the markets, right? It's about a lot of things, but ultimately markets are really about psychology. And so with money printing, you need to keep this business cycle in mind that comes into being with the manipulation of interest rates. But also these different assets react differently in different stages. And of course, again, we have to keep geopolitics in mind and the fluctuations of money from one country to another. And this is why, for example, you can have, big growth in S&P 500 during this century or earlier, while maybe the European stocks have not performed as well. Simply because investors have more confidence in the U.S. economy or just in that stock market, right? So investing obviously is a very hard game, but what we can recognize, I think, if there is one thing we can recognize, is that the asset prices are so much higher today than they used to be 20, 30 years ago across the entire spectrum of investments. So S&P 500, meaning stocks, bonds, they were, the bond market up until 2022 was at historic highs, or in other words, the interest rates were at historic lows in the last 40 years. Housing markets, again, this can be depend on local situation, but usually across the entire countries, houses are unaffordable for average people everywhere. If you think about it, when I lived, so I'm from Croatia. I lived there until the age of 24, and then I lived in Luxembourg, and then I lived in Dublin in Ireland, and now I live close to Lisbon in Portugal. And if you think how that you need to borrow the money and work for 30 years just to have a 1 or 2 bedroom apartment, then you know that something is not really right, because this is everywhere. It's not just in your country, just in your city. There is not just some special situation where suddenly there is a big influx of people and they are all coming to your city buying apartments. If it's everywhere, but we are more or less still, similar number of people on Earth as we were more or less 10, 20 years ago. So how does that happen? And there is the only one possible solution, that all these asset prices, as we see them, as we count them in dollars, in euros, they have risen just because there is more money slashing around and chasing those same goods everywhere. And I think one of the easiest examples also is, it's real estate, obviously, but gold, which is the same everywhere. And if you look at the price of gold 100 years ago was $20, meaning you needed $20 to so a dollar was worth 1/20th of gold, of an ounce of gold, right? And now the price of gold is over $3,000, right? So it's about $3,200. And then people will say, well, gold is not really an inflation hedge. It's more like a security hedge. It reacts more to political, geopolitical insecurities and everything. And that is true. There is truth in that. That all these assets, they in short term they fluctuate a lot to one another, and it is true that there is no one single best performing asset. That's why I think it's also worth mentioning that people should not be religious when it comes to investing. To get into one thing and then get ideological about it, such as gold, such as Bitcoin, such as real estate, or anything else really. And they should really keep their objective views on these different things. And what I really personally liked when as I was reading Michael Maloney's books, he wrote 2 great books. He basically pointed out I think it was in his first book, that all these things, they trade compared to one another. So you always need to be thinking not really how many dollars or euros you're paying for something, but more like how much does one thing now cost me compared to another, right? So for example, how many ounces of gold do I need to pay now for an average house or for an average car? So in other words, is gold overvalued or is it undervalued historically, right? And this is how we need to think in general about trading different assets, different things. And of course, one thing I like about investing is that you can be gambling on startups and other things. It can pay off really well, but it can also cost you dearly. But at the same time, you can be buying quality assets. You can always buy quality assets at lower prices. You need to find them, or you need to trust someone to find them for you. But there are different ways to make money in the markets, and even if some asset prices don't go up, if you know what you're paying for, right? As Warren Buffett said, price is what you pay, value is what you get. If you pay low amount of dollars, let's say, for a certain stock, where you get paid dividends or you pay a low amount of dollars for an apartment that brings you rent, that can too be a good investment, even if the price of that asset doesn't rise over time.
It's a definitely complex topic. All right, Ivan, that's all the questions I have for you today. I want to thank you for joining me and sharing your thoughts on inflation, the monetary policy, and money in general. Before we go, where can our listeners get a copy of your book or get in touch with you in case they have any questions?
So I do have a LinkedIn account, Ivan Pavlovic on LinkedIn. I have a Twitter account that I don't use much. I'm not very active there, but it's IVANNPVL. And the book is called Making Money on the Money Printer. It's available on Amazon, so on all Amazon websites. It was so it's I will not speak much about the book. I just want to say, really, for the listeners, it contains 10 different topics inside that are all correlated to one another through the topic of money and inflation. And I think this is the shortest and quickest way for everyone to learn about some of the most important things to understand in the next, I would say, at least 5 to 10 years, but also in general.
Great. We'll include all that in the resources section of the show notes. Thanks again, Ivan, and thank you to everyone who tuned in today.
Thank you very much, Mark.